Preparing for accounting at Xcel Energy interview? You've reached Candy Mentor, and this video is for you. We'll walk through 25 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. How does utility accounting differ from accounting in a typical industrial company? Utility accounting is shaped by regulation because revenues and customer rates are often approved through a regulatory process. I would emphasize rate base, recoverable operating costs, long-lived infrastructure, depreciation, and regulatory assets or liabilities. Unlike a typical manufacturer, a utility may defer certain costs when regulators expect future recovery. I would also mention FERC Uniform System of Accounts requirements and the importance of connecting accounting treatment to approved rate cases, customer affordability, and long-term reliability. While answering, focus on regulation, rate recovery, large capital assets, long useful lives, cost of service economics, FERC requirements, and how accounting balances generally accepted accounting principles reporting with regulatory commission decisions. Question 2. What is a regulatory asset, and when might Xcel Energy record one? A regulatory asset represents a cost incurred today that regulators expect the utility to recover from customers through future rates. Examples could include qualifying storm restoration costs, pension-related amounts, or certain environmental expenditures. I would record it only when recovery is probable under applicable regulatory guidance, then amortize it as the related revenue is collected. I would also monitor regulatory decisions because a change in expected recovery could require impairment or accelerated write-off. Make sure to cover the definition, probable future recovery through rates, examples such as storm costs or pension expense, amortization, impairment considerations, and the distinction from an ordinary operating asset. Question 3. What is a regulatory liability, and how is it different from deferred revenue? A regulatory liability generally arises when a utility collects amounts from customers before providing the related benefit or when regulation requires future credits or refunds. For example, excess depreciation recovery or certain tax benefits may be returned through lower future rates. Deferred revenue, by contrast, usually comes from a customer contract under revenue recognition guidance. I would assess the regulatory order, expected customer treatment, and timing of recognition rather than automatically classifying every deferral as revenue. In your answer, distinguish regulatory liabilities from contract liabilities, discuss amounts collected before related costs or benefits, explain customer refunds or future rate reductions, and mention required amortization and disclosure. Question 4. Explain rate base and why it matters to Xcel Energy's accounting. Rate base is the investment on which a regulated utility is permitted to earn an authorized return. It commonly includes qualifying plant and equipment, construction work in progress where allowed, and selected working capital balances, less accumulated depreciation and other offsets. For Xcel, capital investment in generation, transmission, distribution, and cleaner energy infrastructure can influence future rate base. Accounting must therefore track additions, retirements, depreciation, and regulatory approvals accurately because those records support rate case recovery. Be sure to mention prudent utility investment, net plant, working capital, accumulated depreciation, authorized return, regulatory approval, and the relationship between rate base growth, capital spending, and earnings. Question 5. How would you account for property, plant, and equipment at a regulated utility? I would capitalize costs that are directly attributable to constructing or acquiring utility assets and that provide probable future economic or regulated service benefits. During construction, eligible costs may remain in CWIP, including certain financing costs, before being placed in service. Once operational, assets are depreciated over approved useful lives, often by functional class. I would also track retirements, work orders, component replacements, asset retirement obligations, and subledger to general ledger reconciliations. Focus on capitalization criteria, direct and indirect costs, componentization, depreciation, asset retirement obligations, retirements, construction work in progress, and reconciliation between subledgers and the general ledger. Question 6. What is AFUDC, and how would it affect Xcel Energy's financial statements? AFUDC, or allowance for funds used during construction, represents financing costs associated with qualifying utility construction. A utility may capitalize an approved debt component and equity component while an asset is being built, rather than recognizing all financing cost immediately. This increases CWIP and eventually the depreciable plant balance, while the related income statement presentation depends on applicable rules and company policy. I would verify eligibility, approved rates, project timing, and proper transfer when placed in service. Make sure to explain allowance for funds used during construction, debt and equity components, capitalization during qualifying construction, revenue and expense presentation, regulatory recovery, and the effect on asset balances and future depreciation. Question 7. How would you determine whether a cost should be capitalized or expensed? I start by asking whether the expenditure creates or enhances a long-term asset, extends useful life, increases capacity, or improves functionality. Routine repairs and maintenance generally belong in operating expense, while qualifying replacements or upgrades may be capitalized. I would apply the company's capitalization policy, unit of property guidance, materiality thresholds, and regulatory requirements consistently. The decision matters because capitalization affects current earnings, rate base, future depreciation, cash flow presentation, and the evidence needed during an audit. Discuss future benefit, unit of property, repair versus improvement, capitalization thresholds, regulatory treatment, consistency, materiality, documentation, and how incorrect classification affects earnings, rate base, depreciation, and controls. Question 8. How is depreciation expense calculated for utility assets? Depreciation allocates a utility asset's depreciable basis over the period it provides service. I would consider original cost, estimated salvage value, approved useful life, and the applicable straight line or composite method. Utilities often use group or composite depreciation because thousands of similar assets are managed together. I would reconcile depreciation schedules to plant records and investigate changes in retirements, useful lives, or regulatory orders, since depreciation affects both earnings and the rates customers ultimately pay. In your answer, cover depreciable basis, useful life, salvage value, method, regulatory approval, composite depreciation, changes in estimates, and the effect of depreciation on rate base and customer rates. Question 9. How would you account for a major storm that damages Xcel Energy's infrastructure? I would first identify and separately track incremental storm restoration costs, including labor, materials, contractor charges, and damaged asset retirements. Normal maintenance would remain in operating expense, while extraordinary costs might qualify for regulatory deferral if recovery is probable. I would also record insurance recoveries when appropriate, avoid double counting recoverable amounts, and reconcile project costs to invoices and work orders. The final accounting would depend on regulatory orders, materiality, and the expected mechanism for customer recovery. Be sure to mention emergency restoration costs, normal repairs versus extraordinary costs, regulatory recovery, insurance proceeds, regulatory assets, accruals, documentation, and potential customer rate treatment. Question 10. What revenue recognition issues are important for an electric and gas utility? Utility revenue is generally recognized as electricity or gas is delivered, based on approved tariffs and customer usage. At period end, I would accrue unbilled revenue for consumption after the last meter reading, using usage estimates and current rates. I would separately evaluate fuel clauses, purchased power adjustments, weather-related estimates, and regulatory true-ups. Strong controls around meter data, billing interfaces, rate tables, and subsequent cash collections are essential because small estimation errors can materially affect quarterly revenue. Focus on customer contracts, metered usage, estimated unbilled revenue, tariff-based rates, fuel and purchased power adjustments, alternative revenue programs, true-ups, and the timing of billing versus service delivery. Question 11. How would you calculate and validate unbilled revenue at month end? I would estimate usage delivered from the last meter read through period end, segmenting residential, commercial, and industrial customers where their consumption patterns differ. I would apply the applicable approved tariffs, including relevant demand or fuel components, and compare the estimate with historical usage, weather, and subsequent billings. I would document the methodology, reconcile the calculation to the general ledger, and perform a reversal or true-up when actual invoices become available. That process supports accurate cutoff. Discuss consumption estimates, meter reading cycles, weather and seasonality, approved tariffs, customer classes, subsequent billings, analytical review, cutoff, and reconciliation to the billing system and general ledger. Question 12. What is the accounting impact of fuel and purchased power cost adjustments? Fuel and purchased power clauses can allow a utility to recover eligible cost changes from customers through future rates rather than absorbing all volatility immediately. If costs incurred exceed amounts billed, the difference may create a regulatory asset when recovery is probable. Over-collections may create a regulatory liability. I would reconcile actual fuel and power costs to approved recovery rates, consider lag effects, and assess regulatory orders before recording the balance or its amortization. Make sure to explain pass-through mechanisms, regulatory assets or liabilities, timing differences, customer refunds or surcharges, estimation, and how actual costs compare with amounts recovered through approved rates. Question 13. How would you account for an asset retirement obligation for a power plant or wind facility? I would recognize an asset retirement obligation when a legal or contractual obligation exists and the liability can be reasonably estimated. The obligation is initially measured at present value, with a corresponding increase to the related asset. Over time, the liability grows through accretion expense, while the asset component is depreciated. I would update assumptions for timing, removal costs, inflation, and technology changes, then evaluate whether regulatory treatment permits recovery from customers. Cover legal or contractual obligations, present value measurement, credit-adjusted risk-free rate, initial asset increase, accretion expense, changes in estimates, settlement, and regulatory recovery. Question 14. How would you assess impairment of a utility-generating asset? I would begin with triggering events such as declining demand, sustained market price changes, regulatory decisions, environmental requirements, or a planned early retirement. I would then apply the relevant generally accepted accounting principles model to compare carrying value with recoverability and fair value, using forecasts that reflect dispatch, fuel costs, contracts, and decommissioning obligations. Regulatory recovery may affect the analysis but does not eliminate the need for impairment testing. I would clearly document assumptions and sensitivity results. In your answer, discuss triggering events, recoverability, undiscounted cash flows where applicable, regulatory support, retirement decisions, market conditions, and the distinction between impairment and normal depreciation. Question 15. What accounting considerations arise when a coal plant is retired early? An early coal plant retirement requires a coordinated review of impairment, remaining net plant, decommissioning costs, environmental obligations, and the asset retirement obligation. I would assess whether continued depreciation is appropriate, whether regulatory recovery supports a regulatory asset, and whether accelerated depreciation or a write-off is required. I would also consider severance, contract termination, inventory, and disclosure impacts. The accounting should reflect both the economic retirement decision and the regulator's approved customer recovery mechanism. Focus on asset impairment, remaining net book value, retirement costs, arrow changes, regulatory recovery, depreciation revisions, employee obligations, environmental liabilities, and disclosures about strategic transition plans. Question 16. How do deferred income taxes commonly arise in a regulated utility? Deferred taxes arise when book and tax bases differ, especially because tax depreciation may be accelerated compared with regulatory or financial statement depreciation. A regulated utility must also consider normalization rules and whether tax benefits are retained, flowed through to customers, or recorded in a regulatory account. I would reconcile the effective tax rate, deferred balances, and statutory changes, then assess valuation allowances where relevant. Cash taxes can therefore differ materially from reported income tax expense. Be sure to cover tax depreciation differences, normalization, accelerated depreciation, regulatory assets or liabilities, flow-through treatment, valuation allowances, and the relationship between book tax expense and cash taxes. Question 17. How would you account for pension and other post-retirement benefits at Xcel Energy? I would measure the benefit obligation using assumptions such as discount rates, salary growth, mortality, and healthcare trends, then compare it with fair value of plan assets. The income statement typically separates service cost from other pension components, while actuarial gains and losses may enter other comprehensive income or a regulatory account depending on applicable treatment. I would reconcile contributions, benefit payments, and funded status, and explain how market performance or rate changes affect future expense. Discuss projected benefit obligations, plan assets, service cost, interest cost, expected return, actuarial gains and losses, regulatory deferral, funded status, and sensitivity to discount rates and asset returns. Question 18. What lease accounting issues could arise for a utility such as Xcel Energy? I would review contracts for identified assets and the right to control their use, including embedded leases in power purchase, land, transmission, or equipment arrangements. After determining classification, I would record the appropriate right-of-use asset and lease liability, using the correct discount rate and lease term. I would monitor renewal options, modifications, variable payments, and impairment indicators. For a utility, the key risk is overlooking leases embedded in complex energy and infrastructure agreements. Focus on identifying leases in contracts, operating versus finance classification, right-of-use assets, lease liabilities, embedded leases, renewable facilities, land, equipment, and reassessment of terms or options. Question 19. How would you reconcile the general ledger to a utility plant subledger? I would start with the prior period's approved reconciliation, then roll forward beginning plant balances for additions, transfers, retirements, depreciation, and other adjustments. I would tie construction work orders and project closeouts to invoices, approvals, and placed in service dates, then compare the subledger totals with the general ledger by asset class and jurisdiction. Any difference would be investigated promptly, with aging, root cause analysis, and documented review before close certification. Mention beginning balances, additions, transfers, retirements, depreciation, disposals, work orders, CWIP, project closeout, subsidiary records, variance thresholds, and investigation of unexplained differences. Question 20. What key controls would you expect in Xcel Energy's fixed asset accounting process? I would expect controls over capital project authorization, purchase orders, work order coding, capitalization review, placed in service dates, retirements, and useful life changes. Segregation of duties should separate project approval, invoice processing, journal preparation, and review. Periodic reconciliations between the plant subledger, general ledger, and construction system are important, as are access controls and evidence of management review. I would test both control design and operating effectiveness, then evaluate whether exceptions could affect rate base or financial reporting. In your answer, discuss authorization, project coding, capitalization review, segregation of duties, approval of retirements, system access, reconciliations, physical verification, change management, and audit evidence. Question 21. How would you analyze a variance in operating and maintenance expense? I would decompose the variance into volume, price, timing, mix, and unusual event drivers rather than relying on a single percentage. For example, an unfavorable maintenance variance could reflect storm restoration, planned outages, contractor rates, or an accrual posted earlier than expected. I would compare actuals with budget, prior year, operational metrics, and subsequent invoices, then determine whether the result is a valid business fluctuation, a cutoff issue, or a forecasting problem requiring escalation. Be sure to cover budget versus actual, volume and rate drivers, weather, outages, storm activity, labor, fuel, timing, accrual reversals, materiality, and whether the variance requires a forecast or accounting adjustment. Question 22. What are the most important month-end close procedures for a utility company? A strong close starts with a clear calendar, ownership, and materiality thresholds. I would prioritize revenue cutoff and unbilled usage, fuel and purchased power accruals, payroll, depreciation, storm costs, regulatory amortization, intercompany activity, and account reconciliations. I would use analytical review to identify unusual movements, obtain support for manual entries, and resolve aged reconciling items. Finally, I would document management review and ensure that late information is evaluated consistently before financial statements are issued. Focus on cutoff, unbilled revenue, fuel and power accruals, payroll, depreciation, regulatory entries, intercompany balances, reconciliations, analytics, review controls, and meeting a compressed reporting timetable. Question 23. How would you explain the impact of capital expenditures on the three financial statements? When Xcel spends cash on a qualifying capital project, investing cash flow decreases and CWIP or PP&E increases on the balance sheet. There is usually no immediate operating expense for the capitalized portion, although interest or other costs may follow specific rules. Once placed in service, depreciation reduces earnings and operating cash flow through the indirect method, while the asset balance declines. Financing the project can also affect debt, interest expense, liquidity, and future rate base recovery. Discuss cash outflow, CWIP or PP&E increase, capitalization timing, no immediate expense for qualifying costs, future depreciation, financing effects, operating cash flow, and eventual earnings impact. Question 24. How would you evaluate a potential contingent liability from environmental remediation? I would determine whether a present obligation exists, assess the probability of loss, and estimate the amount using available engineering, legal, and regulatory information. If the loss is probable and reasonably estimable, I would accrue the best estimate or an appropriate range. I would separately evaluate insurance, third-party recoveries, and possible regulatory recovery, without netting them improperly. I would update the estimate as site conditions or requirements change and ensure disclosures explain material uncertainty. Mention legal obligations, probability and estimability, loss accrual thresholds, cleanup estimates, insurance or recovery, regulatory assets, discounting, changes in assumptions, and transparent disclosures. Question 25. Why do you want to work in accounting at Xcel Energy, and how would you add value? I'm attracted to Xcel because its accounting sits at the intersection of essential infrastructure, regulation, and the energy transition. The company's investment in grid modernization and cleaner generation creates technically challenging work involving PP&E, regulatory accounting, taxes, and long-term estimates. I would add value through disciplined reconciliations, thoughtful variance analysis, strong documentation, and clear communication with operations and regulatory teams. My goal would be accurate reporting that supports sound decisions, reliable service, and appropriate customer outcomes. In your answer, connect Xcel's regulated utility model, energy transition, infrastructure investment, reliability mission, technical accounting, controls, collaboration, and your ability to turn detailed analysis into dependable reporting. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.